All right, welcome back. My name is Chris Saginelli, and I get to build, buy, and sell simple profit businesses every single day. And today we're going to be continuing our buy, sell boot camp series, and we're coming close to the end here. We've already gone out, we found a deal in market, we completed our preliminary diligence, we positioned an LOI, we went through, completed our due diligence, we built our 100-day plan, we then went through and negotiated our purchase agreement. We're now at the point of the money function. And in today's conversation, we're going to be talking about deal financing, different ways to finance a deal, right? Because at the end of the day, one of the contingencies is the money has to be there, right? The money has to be there in order to close the deal, right? In order to get to the acquisition and get over the finish line. So today's conversation, we're going to try to keep it fairly simple because this can be complex. This is also a personal passion of mine in terms of a place of the deal. I love the deal structure. I love the deal financing. I love getting the deals done in every aspect, in every possible way. So I'm going to try to keep it simple because I otherwise could very much so just kind of go off the rails and talk probably forever on this. And before I do, though, and before we get into anything, I do want to acknowledge the fact that this information provided in this video is 100% for educational purposes only, does not constitute any legal, financial, professional advice. And if you are in the process, you are looking for a deal, you're looking to get something done, please consult with a licensed professional before making any decisions. Do not make any decisions based on the information in this video. That being said, when we're talking about deals, right, we're talking about the ability to finance a deal. And sometimes we need to be strategic, right? Oftentimes, the best way that we can approach a deal is from a perspective of strategy and strategic financing, right? The financing at the end of the day, many people think it's just the cash, right? Many people think it's just the monies that is being exchanged, but realistically, it's the consideration, right? So it's the financial consideration in terms of a this for that, and the this for that in this situation would be what we're providing on the buy side to the sell side for them to exchange in consideration the business or the assets, right, of what we're acquiring. That being said, there's many different types of financing, and there's different types of ways in which you can get access to financing. There's different types of ways in which you can structure strategic financing. In today's video, I'm going to go through high level, top, most common forms, and they're going to be simple and then a little bit less simple. And I will also do a high level of like some creative financing structures as well, so you get a little bit of a sense of it. But for the most part, you got cash, right? You got debt, you got equity, and then you got seller. That's typically like the ways in which most deals get done for the most part. But again, there are some creative ways that you can do it. Now, going into the debt financing is typically the first thing that somebody does if they don't have the cash on hand and they want to actually go out and just purchase the deal outright, right? So like if you don't have the money in your bank, then you go to the bank pretty much. And that's debt financing. Like think about it like buying a house, right? You can either go and make an all cash offer and you go and you buy your house for 100K and you give them 100K, or you go to the bank, you get a mortgage and the bank pays the 100K and you pay the bank over time, right? Maybe a little bit of money down. That's debt financing. That's traditional debt financing. It's not very much different when it comes to buying a business, right? So it's going to involve a lender, probably a bank, maybe some other third party. They're the ones that are going to front the money. So they're going to put up the money that the seller actually gets. So the seller's clearing out of the deal in this situation. They're clearing out, you're taking possession of the deal. Typically why, on the buy side, somebody would go debt is because, they don't want the seller to be involved, or they just want the deal to get done. Or maybe there's sticking points to the deal where the seller, refused to do anything else in terms of creative financing. There's no real flexibility. So it's just like, everybody kind of parts ways because the seller gets paid. Now the buyer takes on the responsibility, the liability of the asset. The liability asset hopefully will produce enough incremental cash flow and profitability from running and operating the asset that it can then service the debt. And because of that, it's a good deal and everybody's able to be happy. The machine keeps moving forward, right? Now, there are disadvantages to that too, right? So for those reasons of simplicity, everybody gets cleared out of the deal. That's an advantage, right? But there's also disadvantages in the fact that, oftentimes the debt comes at fixed structured payments, and oftentimes, maybe there's changes or shifts, into a new business, especially post acquisition and stabilization, unforeseen things. Maybe there's a downturn, maybe there's market trends downturns, or whatever the case is. There's a good chance that maybe in a pure debt financing deal that there's a lot of risk on the business, on the deal, and maybe the deal ends up underwater, and the business itself is not able to operate in a sufficient enough manner to suffice to service the debt, and that's risk, right? So for those reasons and definitely more, it's definitely a good place and a common place for folks to start. It's a great place for folks to think about. And if you're able to get a deal done with low risk ratio, it's a good way to do a deal. However, sometimes that's not the case, and sometimes the deal can't be underwritten, or the credit's not there to be able to secure the debt in the first place. There's a lot of whys in life. Life is a very real thing. So sometimes you can't do a debt deal. If you can't do a debt deal, another way to get a deal done is to approach equity financing. In the form of equity financing, the situation is like the buyer, their credit or whatever the situation wasn't good enough to get debt. So what they do is they go and find, a financier, somebody with money or with capital. And instead of underwriting it as debt and a loan, they come in and they buy a percentage of the business with the buyer, and they become an equity partner. So now they're in business together. The difference between debt and equity, right? Debt is fixed, right? On a debt side, on a loan side, as a debt lender, you're getting preferential treatment if something was to happen to the business. So you're going to get paid out first prior to any sort of equity players. On the equity side, the benefit is that there's kind of like an infinite upside, right? So debt, it's fixed and finite in terms of what you're going to receive back, right? But you get a preferential treatment in terms of if there's something bad, right? On the equity side, you're taking on more risk, but you have the infinite upside of the growth and potential of the business. So a typical equity investor could be like an angel investor or a private equity firm who will come in and take a minority stake potentially, or even a majority stake and put you in as an operator. Some VC firms could be considered this in terms of strategic buyout firms. Crowdfunding, definitely, like say you wanted to get the deal done, you could do some sort of Reg CF to a certain extent to be able to do that. So any way in which you're bringing on investors into the deal and they're getting an exchange instead of a debt note or a debt obligation, they're getting equitable upside. And that could be equitable upside with like covenants and restrictions and things and preferences, right? So they could end up receiving different types of terms similar to like a debt. However, long story short, net is equity is somebody's buying into the business, and debt is somebody's like underwriting the business, providing capital to support under the business. If you're in a situation and you're not able to get debt financing and you're not able to bring in capital into the equity of the deal, and you still want to get the deal done, there are other ways, and probably the most common of other ways, if there's no outside capital, is for the seller to just be the bank, right, and provide the capital. And in this type of situation, you have seller financing. So seller financing is a great option. I love seller finance deals. In fact, structured the right way, I would go far as to say I would probably do any seller finance deal. We also own sellerfinancing.io. So we also own, platforms and exchanges that specifically specialize in supporting the brokerage of seller finance deals. It's a great market to play. And if you can structure the deals in a good way, which, we know how to do, it's a really risk mitigator approach to doing the build, buy, sell game, or the buy, build, sell game, right? But there needs to be a why, right? Again, structured the right way. There's a why for everybody, and you can actually align incentives the right way on the upside for everybody while still mitigating risk on the downside. But the seller needs to be privy and interested in participating in that. That's the difference here, right? With debt or equity, it's all outside capital, and then you're just buying something at par value from the seller, and the deal gets done. In this situation, you're kind of partnering into a deal, and the seller really needs to be bought in. They're carrying a lot of that risk forward. Again, you could structure terms where you could mitigate that, but for the most part, that's the case. So in this situation with seller financing, the seller is the bank. They're gonna extend a note pretty much and allow you to purchase the business from them with their money, right? So it's a wild concept. It's really cool. It's really interesting. So you put the purchase agreement together. You'll have an interest rate onto the deal typically. There'll be a payment schedule, right? Very similar to debt financing. The only difference is as you're making payments back, the payments, instead of going to a bank, are going to the seller. Interest rates are typically much higher in these types of situations. The seller needs to have a motivation as to why would they want to do this and take this incremental risk. But there are also things that you could add in, like clawbacks and things of that nature. But if you miss a payment, the seller gets the business back, things like that. So it's important. It's important to make sure that the business is generating good enough cash flow in any of these deal structures. I mean, least important in equity, important in debt, definitely important for both parties in seller financing, right? So you really want to make sure you're doing a great job doing your financial diligence, and that this is a good, profitable, simple, profitable deal to get done. That's why we love them. Bootstrapper Capital, we're all about simple, profitable deals. But there's risks involved for everybody. But if, again, structured appropriately, there is a way to be able to pull risk out of it. Now, say you're in a situation where none of these three most common forms, debt, equity, seller, or cash, right? Say none of them are really on the table to a certain extent and in their entirety. You can always mix and match, right? So you can mix and match different types of structures. And then there's also different types of other creative financing structures. And there are so many of them. Like, this is probably, I think, why I am so just like such a tank filler for me to work on deals and deal structures, is because you can get really creative with this stuff. And there's a lot of different ways, and there's always a deal to be done, right? So there's always a deal to be done. And if you just tell yourself there's always a deal to be done, it's just a matter of like, how much outside the box can you think, and how good can you be in terms of creative terms and structuring to get that deal done. Some examples of creative financing, asset-based financing. So that would be, you inventory the assets within the business, and then you leverage the assets, the value of the assets, to secure, enough cash to be able to secure, collateralize a loan to be able to get the deal done, right? That's very, very common. Probably something in more of like manufacturing types of deals, things of that nature, where there's a lot of assets that you could collateralize against, right? But you could pretty much collateralize around anything that is possible to do. Crowdfunding, we already talked about. Royalty-based financing, similar to our performance-based capital or acquisition capital, that involves like the purchase of future revenue, pretty much, in order to be able to underwrite the deal. So you have somebody who is willing to come in and buy out future revenue of the business, and then you leverage that capital event to then pay the seller what they need. Earnouts is a great way to reduce the initial upfront cost of the deal. So the seller will have a reduction of initial acquisition price typically. So they'll accept a lower price, so that way you don't have to get as much debt or equity or other creative financing to be able to close into the deal. Sometimes you could even do seller financing with an earnout, which is a great deal structure to do. And in that situation, the deal is structured on the backside, and the seller is potentially getting more in an earnout type of structure if they're taking on more risk. Or it's a situation where you have more perceived risk onto the deal as a buyer, and you think that there could be risk on the backside of the deal with things going wrong with the seller leaving, and you want them to carry some of that risk forward. So it could go either way. All of these structures go either way, right? To structure, mitigate risk into the deal, structure a better deal, get to better terms, get to a better outcome, right? Grants are just the ability to go out and apply for funding that's maybe free money, right? There's a lot of different grants out there. You could leverage grants oftentimes. You collateralized grants oftentimes, right? Lease to own is a concept where you can't go out and get debt, for example, or whatever the situation. The seller's not like 100% interested in doing a seller finance deal, but they want you to take possession. They'll let you pay like a monthly payment or a quarterly payment or whatever it is to take possession to operate. You're making the payments off. You're accumulating profit. You're building up your credit, or you're building up your ability to then, do other financing on the backside. And at the end of that period, you can then buy everything out, right? So it's a lease to own. It's the option to buy at the end. Joint ventures, that's like multiple parties coming together to get something done. And then again, seller finance we talked about, but you can add contingencies onto it. I'm a big fan of seller financing with contingencies because it's a great way to get everybody aligned into the deal, be in the right position at the right time, to be on the right trajectory, and ultimately negotiate something where everybody could be in a win-win type of situation. But remember, there is always a deal to be done. This was super high level, and I kind of quickly went through all these deal structures. Each one is fairly sophisticated and complicated. You can always, try to keep it simple, but again, simple doesn't mean easy, right? Simple is pretty hard. So, definitely be as creative as you possibly can. If you want to be able to get into a deal, there's always the potential to be able to get into the deal. The most important thing, though, is like while you're going through the process, being upfront, right? So if you're on the buy side and you don't really have the money, right? Be upfront, be earnest about that. Again, we discussed that in the LOI video, but like you make these disclosures, right? Be a good person, get into the conversation early, because oftentimes if you can, and you're a good person, right? Good typically gets good, right? You got to give to get, right? And it's a great way to position this. And then you can open up these conversations. And by opening up the conversations, the creativity can flow. And again, if it's something that you really want, I don't live in a world of guarantees, because we don't live in a world of absolutes, but you could virtually guarantee that, if you really put your effort and energy, there's quite usually always a deal to get done, right? It's a big world out there. There's a lot of resources, and there's a lot of ways to approach things, right? Tons of different ways to skin a cat. If you want help, doing these types of things, definitely reach out, right? It's something that I personally love doing, but we also do, and we provide a service through our business brokerage to do it. We also have a lot of resource to be able to provide to do it. If you enjoy this content you're watching on YouTube, please like and subscribe. We're trying to build up this channel. We appreciate it. And if you are in the buy sell bootcamp, appreciate you for following along to this point. We're pretty close to the end. We're at the point we're about to get to the closing process, and it's almost going to be a done deal, right? It's like we get to the close. Now we're going to take possession. Then it's all about integrating, stabilizing, and then optimizing this asset, right? Which is where you're building the wedge. That's how you make your money, is you buy low, you sell high. All right, but you're almost there. See you on the next one.